Okay, let's unpack this. We are witnessing something utterly divorced from traditional market fundamentals. It's this phenomenon where a single strategic policy announcement, from the White House, acts as this explosive market catalyst.
Yeah.
It delivers instantaneous triple-digit returns to investors in companies that were frankly pretty obscure before. This isn't just volatility. This is government-driven alpha.
That phrase government-driven alpha is really the perfect descriptor, isn't it?
Mhm.
We are observing the radical, tangible effect of national security policy being deployed as unconventional industrial policy.
Right.
It is fundamentally reshaping how market valuation is calculated.
Yeah.
Sometimes overnight, based purely on perceived strategic relevance to Washington, D.C.
And the evidence is just undeniable. I mean, just this week, we saw the immediate dramatic impact of this exact strategy. Shares of Trilogy Metals, ticker TMQ, it's a Canadian exploration company, they skyrocketed. We're talking between 220% and 280% in early trading on one single day, Tuesday, October 7th. That was right after the Trump administration announced it was taking a direct equity stake in the company. That kind of sudden movement completely short circuits traditional due diligence.
It really does.
Yeah.
And what's fascinating here is that we're looking at a fundamental shift where national security policy is directly translating into market valuation. The government is essentially validating these businesses.
And funding them, de-risking them.
Exactly. Funding and de-risking them. So for an investor, understanding this shift is crucial because the U.S. isn't just backing these companies. It's practically guaranteeing their long-term strategic priority. And importantly, providing the infrastructure needed to execute.
Okay, so our mission today is to decode this. This deep dive is about providing you, the listener, with the playbook to identify the opportunities and, let's be clear, understand the extraordinary risks inherent in trying to, preempt the White House.
Yeah, preempt the White House.
So what are the core sectors the administration has deemed strategically vital here?
The focus is ruthlessly targeted. We're looking at industries deemed critical to national security, which primarily means securing the building blocks of the future economy, right?
Okay.
So that includes mining, specifically things like rare earths, lithium, copper, cobalt, gallium, germanium, and then the advanced processing capabilities, which brings us directly to semiconductors, the sort of high-tech brains of that future economy.
Right. Let's start with the foundational geopolitical why. The administration is pursuing what you called an unconventional approach to industrial policy. What makes this approach unconventional compared to, say, past government interventions? And how did we even get to a point where the government feels compelled to act as a direct equity investor?
Well, the unconventional nature, it really lies in the directness and the sheer scale of the government stepping outside of, traditional contracting and grants and directly into private equity.
So not just funding research, but actually owning a piece.
Precisely. Historically, the U.S. government has really avoided taking ownership stakes in private, publicly traded companies, except maybe in times of extreme crisis, like wartime or major bailouts.
Okay.
This approach dramatically expands federal influence over business operations and capital allocation to a degree we haven't really seen since, wartime mobilization. And the primary driver for this is crystal clear: the heightened strategic tensions with China.
Okay.
And the urgent need to secure supply chains vital for defense and, just as importantly, technological superiority.
And the core vulnerability that really triggered this policy shift is China's dominant position in the resource sector, correct?
Absolutely. China is not just a major player. They currently mine and process the vast majority. We're talking upwards of 80% to 90% in some specific categories of the world's rare earth minerals and magnets.
80 to 90%, that's staggering.
It is. And this dominance gives Beijing immense geopolitical leverage over any nation that relies on those inputs, any nation including the U.S.
We actually saw this leverage weaponized earlier this year, didn't we?
Right.
Can you drill into that curve? What was the specific mechanism China used, and what was the immediate impact on U.S. industries that rely on those minerals?
Yeah, it was a targeted, very calculated move. China didn't implement a total blanket ban, Rather, they used targeted export quotas and introduced deliberate regulatory roadblocks for certain sensitive shipments, particularly rare earth oxides.
So they squeezed specific points in the supply chain.
Exactly. The disruption, it only lasted a few months, but the damage was profound, psychologically as much as anything. It immediately exposed the fragility or the tenuousness, as the sources describe it, of America's critical minerals supply chain.
And who felt it first?
The first industries to really feel the squeeze were specialized component manufacturers, particularly those supplying the defense sector and advanced electronics.
Graphically.
Exactly. The strategic resources they are targeting, copper, cobalt, gallium, germanium, and others, they're vital, but they are trapped behind massive logistical and regulatory barriers. So the equity stake alone, it signals immediate regulatory certainty and strategic priority. It basically tells the market this project will happen no matter what.
And the single biggest logistical barrier was the lack of access to this remote region, right? This is where the infrastructure component becomes the true driver of value that investors are betting on.
Absolutely. The direct equity stake was just one part of the policy package. Simultaneous to the investment announcement, President Trump issued an order. He mandated federal regulators move forward with permitting the construction of a staggering 211-mile road to access the Ambler District.
A 211-mile road in remote Alaska?
Pretty much. But with the federal government committing capital and regulatory muscle to build the required 211-mile corridor, the entire operational risk profile of Trilogy Metals changes instantly. It confirms they will get those strategic metals out of the ground, hence the 220% to 280% return on the day. The investment acts as a profound operational de-risking event.
TMQ is the latest example, but this policy playbook was used earlier this year with Lithium Americas, LAC. What was the mechanism there, and what was the strategic resource focus?
Right, Lithium Americas, another Canadian-based entity, by the way. This deal focused on lithium, obviously critical, the foundational resource for the electric vehicle and grid storage revolution.
Can't build batteries without it.
Nope. The deal involved the Department of Energy, the DOE, restructuring an existing arrangement. The DOE specifically restructured the existing terms to take a direct 5% equity stake in the company and, importantly, an equal stake in the highly strategic Thacker Pass lithium mine in Nevada.
Okay, Thacker Pass. So this action reinforces the idea that the U.S. isn't limiting its attention strictly to domestic U.S. headquartered entities if the resources are strategically vital and accessible, even if the headquarters is in Vancouver, like with TMQ and LAC.
That's the critical nuance for investors, I think. The U.S. is focused on resource security within its immediate sphere of influence. It seems they're prioritizing access to the critical elements over the corporate nationality of the parent company, as long as the resource is physically located in North America or is otherwise accessible. Makes sense strategically.
And the market reaction followed suit with LAC too, right? I recall the stock jumped significantly.
It did. LAC stock was recently up, 28% after this news, or even speculation about the news. It just suggests that even whispers or confirmation about restructuring a deal to include an equity stake is a massive catalyst. It signals government intent.
So again, government equity equals security and stability in the market's eyes.
It reinforces that signal, yes. If the DOE is willing to restructure a deal to take a physical stake in the mine itself, it means the government views that asset as critical, essential, and likely insulated from future political disruption or regulatory hurdles.
And then there's MP Materials, ticker MP. They've kind of been the poster child for this strategic pivot all year, haven't they?
They really have. Back in July, the Department of Defense, the DoD, stepped in. They bought a staggering $400 million of MP Materials stock.
$400 million, that's a serious commitment.
It is. The specific financial mechanism involved the DoD directly purchasing common stock, instantly making the Pentagon the largest single shareholder of this rare earths miner.
Yeah.
This is a direct linkage between military strategic needs and immediate massive capital deployment.
$400 million from the Pentagon isn't just an investment. It feels like a clear strategic mandate, guaranteeing the viability of their Mountain Pass operation in California.
It is the ultimate institutional endorsement, you could say. MP Materials operates the only rare earth mining and processing site of significance currently operational in the U.S., out there in California. By taking the largest equity stake, the DoD ensures domestic access and control over a strategic resource that feeds directly into defense applications, things like high-performance motors and magnetic systems.
And that explains its stock performance.
It certainly helps explain why MP Materials has been the best-performing stock in the Russell 1000 index this year. In exchange for granting permission for these sensitive but highly lucrative sales, which, still provides revenue for the U.S. company, the government secures a direct percentage of that revenue.
So it functions almost like a strategic tax or a royalty?
Kind of like a strategic tax or royalty on market access for restricted technology, yeah. This mechanism allows the government to, theoretically, control technology proliferation while simultaneously generating some capital and supporting the domestic champions who create this innovation. It's quite intricate.
So if we connect this all to the bigger picture, it becomes really clear that this is almost like an economic war being fought with equity stakes, regulatory mandates, and now shared revenue. The scope is holistic, from the raw earth in Alaska to the 7-nanometer chip fab in Arizona.
That is the synthesis, I think.
Yeah.
The government is using its financial and regulatory weight to control key parts of the future industrial complex. And for you, the investor, this creates a situation where geopolitical strategy becomes, arguably, the primary fundamental metric for valuation in these specific sectors.
Okay, that brings us directly to the core of the matter for our listeners.
Yeah.
Investor opportunity, speculation, and of course, risk. Since we know the policy driver securing supply chains isn't going away anytime soon, investors naturally expect more deals to come.
Right.
This presents a unique, high-risk, high-reward opportunity for those confident they can, as we said, preempt the White House.
Preemption is definitely the operative word here. And the market has already shown that pure speculation, based on even the slightest whisper of government interest, is enough to create massive spikes in share price. If you can identify the next company in Washington's sights, well, the potential gains are immediate and substantial.
The case of USA Rare Earth, USR, is the perfect example of this speculative momentum, isn't it? This was pure communication alpha, not even financial investment alpha yet.
That's exactly right. Shares of USA Rare Earth soared, 15% in recent trading, after an initial jump of 23% the day before. Almost 40% in 2 days.
And what triggered that?
Its CEO, Barbara Humpton, simply confirmed that the company was in close communication with the administration. That was it. That was the trigger. It came when she was asked if they would welcome a government equity investment. No deal was announced. No contracts were signed. Just the confirmation of an ongoing dialogue with Washington.
That insight is critical for the listener, I think. Wall Street is interpreting close communication with the administration as a proxy for being next in line for a massive investment catalyst. It suggests that any public confirmation of high-level dialogue between a critical mineral CEO and Washington, D.C. can trigger double-digit returns instantly.
It's pure market behavior reflecting the perceived value of government endorsement. A simple conversation with the White House, if it confirms the company is strategically relevant in their eyes, can be worth a massive stock jump because it signals that regulatory certainty and capital access are likely forthcoming.
Okay, now let's talk about a company where the conjecture has been even more extreme, resulting in absolutely astronomical returns. The metals company, ticker TMC.
TMC, yes, a prime example of investors betting on a confluence of geopolitical and regulatory alignment. The stock performance has been staggering up something like 560% since the start of 2025.
560%.
Yeah, and it soared another 18.8% just in September. What is absolutely vital for the investor to note here is that the massive September jump was not due to a company announcement about resources or revenue or anything fundamental like that.
It was entirely conjecture, correct. Investors were reading the tea leaves after the Lithium Americas news broke, connecting the dots.
Precisely. Investors were looking at the LAC deal, which involved a Canadian company with a U.S. asset, and they immediately extrapolated that logic to TMC, which is also technically headquartered in Canada, but is a deep-sea mining company.
Right, mining those nodules from the seabed.
Exactly. So this LAC news forced investors to reconsider the assumption that the U.S. government would only back fully domestic terrestrial miners. TMC, with its focus on polymetallic nodules way out in the Pacific Ocean's international waters, became the logical next speculative target for some kind of policy alignment deal.
And what about the secondary driver for TMC, the whole regulatory environment surrounding deep-sea mining? That's still uncertain, isn't it?
It is, and that adds a crucial layer of complexity and risk. Investors were also highly focused on the status of the International Seabed Authority, the ISA. That's the body that governs mineral extraction in international waters.
Okay.
The speculation was further bolstered by news that India had recently signed a 15-year exploration agreement for polymetallic sulfides in the Indian Ocean. This global move signaled to the market that maybe, just maybe, the ISA is potentially becoming more amenable to seafloor mining.
So the hope was the final rules needed for TMC to actually start commercial operations might be closer to being ratified.
That was the hope, yes. That was the speculation feeding the stock price.
So the investor looking at TMC is making a really high-stakes two-part bet here. First, that the U.S. government will view deep-sea minerals as a necessary part of the national security supply chain, perhaps overlooking or rationalizing the environmental concerns. And second, that the ISA will finally finalize the rules that make TMC's operations viable in the near term. That's a lot of ifs.
That summarizes the risk profile perfectly. And this raises an important question for any investor considering these plays. While the potential rewards are obviously massive, the speculation is rampant. It's based entirely on policy shifts and regulatory outcomes, not underlying operational profit.
Right.
The key operational risk for TMC specifically is immense. The long-term viability, the cost, the profitability of deep-sea mining, it's entirely unproven at scale. And furthermore, the final ISA rules could easily be delayed for years or structured in a way that dramatically limits initial profit margins, even if approved.
That is the critical distinction, isn't it? You are investing in government strategy and regulatory timelines, not necessarily a guaranteed P&L statement based on commodity prices alone, like in traditional mining.
And that strategic bet requires intense vigilance and, let's be honest, a huge tolerance for risk. The policy focus is strong, yes, but the volatility is extreme because the market cap is being built on anticipated government intervention rather than proven revenue models or cash flows.
Okay, so to wrap up this deep dive then, the key takeaway for you, the listener, is the profound and direct link between U.S. industrial policy focused on national security, the strategic imperative to decouple, at least partially, from China, and the exponential gains we are witnessing in specific, previously overlooked sectors like critical minerals and advanced semiconductors.
The central realization here, I think, is that the hidden value in these companies is currently derived not just from underlying geological or technological fundamentals, but almost entirely from government endorsement and financial investment. That endorsement acts as the single most powerful instantaneous market catalyst available right now. It's establishing an entirely new investment class driven by strategic necessity.
It forces a complete change in how fundamental analysis is even conducted for these stocks. It's no longer just about quarterly earnings reports. It's tracking White House policy fact sheets and Pentagon procurement mandates. You need a geopolitical analyst almost as much as a financial one.
Absolutely. And this leads directly to our final provocative thought for you to consider. Despite these massive, high-profile investments we've discussed in Trilogy Metals, Lithium Americas, and MP Materials, analysts still anticipate a substantial shortfall in global supply for many of these critical materials.
A shortfall even with these investments.
Yes. Bank of America, for instance, has pointed out that even with the recent strategic boost, the global supply of rare earth oxides outside of China is expected to struggle significantly to meet that booming five-fold demand increase we talked about, anticipated over the next decade.
That paints a picture of a permanent and growing supply deficit, at least for the foreseeable future, which I guess guarantees continued, probably even more aggressive government intervention down the line.
So the question that remains is this. Considering the world is expected to struggle to supply enough rare earth oxides without Chinese supply, how much further will the U.S. government need to intervene? And maybe more importantly for investors, what domestic companies, perhaps currently small, off the radar, or maybe focused on alternative processing techniques or even recycling, what companies might suddenly become the next must-have national asset, guaranteed by federal capital?
Finding the next Trilogy or MP before the announcement.
Exactly. The strategic hunt for secure, non-Chinese supply is only just accelerating. That's something to really think about.